Hello everyone and welcome to the Knowledge Benefit series by Shreyas Vidyalaya. My name is Padmashri. I am pursuing my interest in finance and commerce. Today, I will be providing you with an outline on Stand Up India scheme introduced by the Indian government. There are a wide range of schemes that are being offered by the government of India to aid the economic empowerment of the entrepreneurs by offering the nation's economic resources that benefit not only themselves but also their communities. One of such schemes provided by the Government of India is the Stand Up India scheme. A bit about the background of the scheme as well as what it represents. The government introduced the Stand Up India scheme on 5th of April 2016. The scheme has now been extended up to 2025 as well. It was introduced to ease the challenges that were being faced by the emerging women entrepreneurs and the entrepreneurs who belong to scheduled caste or tribe. Thus, the scheme focuses on setting up an enterprise, obtaining loans, and also providing timely support that these entrepreneurs might require. So that was an introduction to the scheme. We now move on to the concept of Stand Up India scheme. Let us first understand the objective of the scheme. The scheme focuses on facilitating bank loans ranging from 10 lakhs to 1 crore to at least one scheduled caste or scheduled tribe borrower and one woman per bank branch for setting up a greenfield enterprise. Now you may be wondering as to what is a greenfield enterprise. A greenfield enterprise in this context is the first time venturing of the beneficiary. By beneficiary, I mean the scheduled caste or scheduled tribe borrower or the woman entrepreneur in the sector of either manufacturing, servicing, or trading. The next question that generally arises is, how do you decide if the potential borrower is eligible for the said scheme? There are 4 eligibility criteria to be fulfilled. Number 1, the person must be a woman entrepreneur of any background or must belong to scheduled caste or scheduled tribe, and they must be above 18 years of age. Number 2, only greenfield projects are eligible under this loan. Number 3, in case you are a non-individual enterprise, then at least 51% of the shareholding and controlling stake should be held either by a scheduled caste or scheduled tribe member or a woman entrepreneur. Number 4, the potential borrower must not be a defaulter to any bank or financial institution. So once we are clear about the eligibility criteria, we now move on to the features of the scheme. The first feature we'll be discussing is the nature of the loan. The loan provided is a composite loan which includes both term loan and working capital loan. With respect to drawing of working capital, up to a limit of 10 lakh, it will be sanctioned by way of overdraft, and a RuPay debit card is issued for the convenience of the borrower to access his funds. Where the drawings exceed or is above 10 lakhs, in that case, it is sanctioned by way of cash credit facility. Number 2, volume of the loan. As previously mentioned while discussing the objectives of the loan, the volume of the loan may range from 10 lakhs to 1 crore. Number 3, proportion of the loan. The composite loan provided will cover 75% of the project cost, provided that the borrower's contribution plus financial support rendered by any other scheme should not exceed, that is, should be less than 25% of the project cost. Let us understand this with a simple example. Say the project cost is rupees 1 crore. The composite loan will cover 75% of the project cost, which equates to rupees 75 lakhs. However, the remaining 25 lakhs, which represents 25% of the project cost, must be bought in by the borrower himself or along with the financial assistance of other schemes. So once we are clear about the loan amount, the next automatic question is about the interest, which brings us to point number 4. So point number 4, interest rate. The Stand Up India scheme is committed to offer its borrowers with the lowest applicable interest rates of the bank for that particular category. Particular category in the sense, the category under which each borrower is registering themselves under. Therefore, the maximum interest rate provided under this scheme is equal to MCLR, which is the marginal cost of funds based lending rate plus 3% plus tenure premium. Point number 5 talks about the security for the loan. Other than the primary security, the loan may also be secured by the collateral security or a guarantee of Credit Guarantee Fund scheme for the Stand Up India loans. The collateral security and guarantee will be based on the bank's requirements. So this guarantee which is offered is against the default in repayment of Stand Up India credit facilities extended by the lending institutions. Point number 6 talks about repayment period of the loan. So the entire composite loan is required to be repaid in 7 years with a maximum moratorium period of 18 months. The last concept we'll be discussing under the features of Stand Up India scheme is the margin money concept. So point number 7, margin money concept. As we discussed earlier in point number 3, proportion of the loan, 25% of the project cost, which is the margin money, is required to be brought in by the borrower as a borrower's contribution plus financial support rendered by eligible central or state schemes. So the concept of margin money specifically states that the loan applicant's own funds, which means the borrower's own contribution, must equate to at least 10% of the project cost. Therefore, we can conclude that the remaining 15% can be provided by other state or central government schemes as subsidies as well. So to put it in a nutshell, out of the 100% project cost, 75% is covered via composite loan, 10% will represent the borrower's own contribution from his own funds, and 15% will be availed via financial assistance from central or the state government as subsidies. So the above discussed 7 points are the major features of the loan. However, we still haven't answered one important question. What are the institutions that are eligible for extending such loans to the potential borrowers? So all the branches of scheduled commercial banks located across the country are eligible to offer such loans. Now you might be wondering as to how can I avail this loan? So there are 3 ways by which a person can avail this loan. An eligible person can avail this loan. Number 1, approaching the branch directly. Number 2, through the Stand Up India portal, the online website which is www.standupmitra.in. And number 3, through the lead district manager, LDM. So now who is an LDM? So LDM are basically people who monitor the progress of the application and registration and loan application, and ensure that if a potential borrower requires any hand-holding support, such support is provided and the borrower is helped in every which way possible. So that brings us to the end of the topic, concept of Stand Up India. So to all the people out there with various business ideas and who satisfy the eligibility criteria can sign up for the scheme and avail the benefits that are being offered by the Indian government. Thank you all for patiently listening. This is Padmashri signing up.